Good morning, Traderfirstyear here. This is the March 1st, 2021 morning forecast. Markets are implying a move of 1.57% up or down on the S&P 500. Markets have realized a move of 0.96 up or down on the S&P 500. The difference between what market makers are implying and what has been realized has widened. The spread increased to 10 basis points. The put-call gamma imbalance is skewed towards short-dated calls on dip buying. However, a widening spread increases left-tail risk and the potential for delayed spikes in realized volatility upside. Realized volatility has decreased recently below 16. This is favorable for wider and larger moves up or down on the index. However, rising growth or inflation expectations without rising inflation or growth are pushing up real yields, which is creating equity long duration valuation conflicts and raising discount rates. The S&P is expected to move close to 2.99% up or down this week, which means the S&P could decline 6% to 9% above its 200-day moving average, which is 3,447. The S&P is currently trading very close to its 50-day moving average, which is 3,808. Forecasters are expecting nominal growth of 300 billion and real economic output of 130 billion for the first quarter of 2021. Economists continue to place the highest expectations for growth in the second quarter of 2021. Investment banking professionals are forecasting nominal growth of 400 billion and real output of 240 billion for the second quarter. This is a substantial amount of spending on goods and services, which may fail to materialize if there are any further delays in COVID vaccinations or rollouts. Under these assumptions, we would need $50 to $60 billion of spending on personal consumption expenditure in April, May, and June. I think these estimates are overly optimistic, and I continue to rely on more conservative estimates. I think we could see nominal growth in the second quarter of 325 billion to 350 billion, and real output is likely between 180 billion to 210 billion. Weak non-farm payrolls growth and elevated numbers of Americans receiving some form of unemployment insurance or assistance indicates large swaths of slack in the labor market. This key economic indicator is likely to pressure growth in the first half of 2021. However, a finalized fiscal deficit package of 1.9 trillion via reconciliation in Q1 2021 is expected, which is a significant tailwind to nominal growth in the second half of 2021 and the first half of 2022. This assumes virus cases come down substantially by April, May, and pandemic flare-ups lessen. Larger fiscal dis savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the US dollar and downward pressure on corporate and government bond yields. Potentially weaker inflation data than consensus estimates should allow real yields to remain deeply negative. Dollar appreciation dampens import commodity-driven inflation and should lessen temporary transitory base effects. Inflationistas and inflation fear mongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to lead to short-term transitory spikes in inflation data from February, March, April, and potentially May. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risks have diminished in the first quarter due to reconciliation, but it has increased in the second half of 2021 and first half of 2022, which may pose risks to much needed investment spending in infrastructure, human capital, and research and development. So I view it in the medium term as tilted to the upside due to the potential gridlock. Lone wolf domestic terrorism remains elevated. Vaccine distribution priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Details are currently unknown. The market is currently pricing in an additional 4.58% move up or down by March 19th. The S&P 500 could potentially trade as high as 3,974 and as low as 3,639 by March 19th. The VIX is expected to move 7.85%. The VIX is currently at 25.25. The VIX price range is 27.23 to 23.41. The skew index is extremely elevated, which indicates market participants are paying up for catastrophic protection. Those are 2 sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.5%, while the nominal yield on 10-year treasuries has climbed to 1.4%. Real yields on all tenors of government bonds are decisively negative, while real yields on U.S. equities are positive. Disclaimer. With realized volatility rising above 12, there is a large risk of systematic, highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity positioned for a sell-off and reduction in market exposure. The potential for much larger delayed sell-off of 4% to 5% is coming. The March-April VIX contracts at 25 and 28 are still underpriced. They should price near 39 to 47 in my humble opinion. I believe March 2021 could see a continued rise in realized and implied vol. However, I have been wrong before. This last part is just an additional addendum for Traderfirstyear's 2020 to 2025 economic wish list. Number one would be ZIRP, which is zero interest rate policy until 2025, or specific language changes to the Humphrey Hawkins Legislation, which mandates the Federal Reserve to accomplish its full employment portion of the mandate at no less than 3.5% unemployment before beginning a tightening cycle. Wish number two is deficit spending, which incorporates large investment in U.S. human capital, infrastructure, and research and development. Wish number three is a paradigm shift in inflation and concepts related to inflation, tight labor markets, which have no statistical accuracy in the 21st century as policy setting mechanisms. For example, Phillips Curve, NAIRU, and the Taylor Rule, etc. Wish number four, a Congressional, Federal Reserve, and Treasury Department consensus to run the economy above potential trend output for a prolonged period of time. Wish number five, a 5-year pairing of the U.S. Federal Reserve and U.S. Treasury Department accord, very similar to the 1941 to 1951 accord, which was a wartime policy initiative, but we should consider COVID-19 under the same circumstances. Thanks for listening to Trader First Year.